Good afternoon and welcome to Market Domination. I'm Myles Udland, live from our New York City headquarters. There's just under an hour to go until the closing bell. Stocks set for losses on this Tuesday, giving up some gains after we saw all three majors close at records to start the week. Now, this coming after comments from Fed Chair Jay Powell earlier this afternoon. But let's begin with the market action as we welcome in Yahoo Finance's Jared Blickery and Claire Boston. Jared, let's start with you and take a look at what you're seeing in the markets with about 59 minutes to go in the session.
Well, thank you, Myles. We were just looking at the NASDAQ being the leader to the downside today. We'll just skip to that. That's a tech story, and you can see it's down about 244 points right now. This is the intraday price action, so we kind of spiked to some new lows in the 1 p.m. hour. We're just testing them right now, but so far 1%, not the hugest deal. Here's the Dow. It's only down 0.25%. You can see it actually spent most of the day in the green, and the S&P 500 kind of splitting the difference here. It looks more like the NASDAQ chart was green for a little bit in the early innings. And then the Russell 2000 only down 12 basis points, kind of in line with the Dow there. A little bit of outperformance, but still seeing some negative results. And let's skip on down to the bond market, where we have the 10-year yield that is down 3 basis points. We saw it spike a little bit after that FOMC, that big Fed decision last week, but today we are rolling over once again to the downside. 10-year at 4.12%, the 30-year at 4.73%, also down 3 basis points. And the US dollar index, that is down to 97.24. Pretty choppy day there. As you can see, a lot of sideways action. And let me show you what's going up today. That would be gold and crude oil. We've got commodities kind of surging today. 37.96. I did see a 3,800 print in gold futures earlier today. That is a record high. Another one for the yellow metal. This is a year-to-date chart of 42.77%. However, we are not seeing that carrying over into Bitcoin today. Excuse me, that is down 0.2%. This is still a year-to-date chart showing gains of 18%. Here's what has happened today. Now, let's take a look at the sector action real quickly. We got energy up 2%. That is a crude oil story, followed by real estate, staples, utilities, and healthcare. So a lot of defensive sectors in there, so that's not a bullish setup. And then tech, the prior leader, well, for most of the last 2.5 years, that is the biggest loser today. Also consumer discretionary, which is Amazon and Tesla. That's down right on its heels. So here's the NASDAQ 100. You'll see the mega caps largely in the red. Broadcom just barely positive there. Tesla down 1.5%. Amazon down 3%. And I will show you and leave off on the Dow. Pretty red picture here. Couple of bright spots. We got CVX, that Chevron up over 1%, and also healthcare. I said that was strong. United Health up 2%. Myles.
All right, a market where United Health is acting well, not a strong one. Jared, thanks so much. All right, well, Fed Chair Jay Powell warning of, quote, no risk-free path regarding monetary policy during a speech this afternoon in Rhode Island.
Near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside, a challenging situation. Two-sided risks mean that there is no risk-free path.
Now, Powell's comments, somewhat of a reiteration from what we heard from the Fed chair last week after the Fed cut rates. Claire Boston joins me now at the desk to talk a little bit more about what we heard from Chair Powell in comments that come during an extremely busy week for Fed speak.
Definitely. So, what I heard a lot of in Powell's speech today was about how weak the labor market has gotten in his view. He was very comfortable holding rates higher with inflation being strong when labor was also strong. But he was saying that in the past couple months, the situation has really changed. And we've got more from him here.
What we've done all year this year is we've had our policy rate has been tight because inflation has been above our target, but the labor market was very solid. Now, over the last really 4 months, really over the summer, the labor market has softened, payroll jobs have dropped a lot, so we can't really say that anymore.
Yeah, so Powell has a really tricky job right here because he is trying to balance this weaker labor market with the fact that inflation is still pretty high. He also has to wrangle all of these Fed governors who have, frankly, different views about what to do from here. And it's not really clear, as of course he says, what the right thing to do in this moment is. So, they say they're going to stay data dependent. Mm-hmm. They're really going to watch what's going on. We'll see from here.
Yeah, and it's interesting watching the Fed not just change. I mean, I think what's interesting is how maybe 5, 6, 8 years ago, Fed governors come and go. You think, a new person on the Fed, here's their background. It's not that interesting. But now, obviously, Stephen Myron joined the Fed board last week. Potential other changes in the offing. It feels like there's less cohesion, and maybe perhaps Powell's comments are more like they're more his own, is sort of how I felt he was speaking today than in the past, where the Fed chair is obviously super cognizant of the fact that they are by far the most important voice. Not to say he's unimportant at this point, but he feels like it feels like Powell on speaking on Powell rather than Powell on behalf of everybody else.
Definitely. There is not really a clear consensus view right now. We're seeing a lot of Fed speak, as you alluded to this week. Many Fed governors were saying that they're still pretty worried about where inflation is. And I'm really curious to see, how that factors into this October meeting that we have. The governors, of course, were penciling in a cut, at this meeting. But, we are going to get quite a bit more data between now and then. And we'll have to see sort of where things shake out with some of that inflation data.
And the other thing that he said quickly before we go was talking about the stock market and kind of saying, things are high. I see them out there. Don't worry. Don't think I'm ignoring it. And I always take note when, look, he's asked the question, he answers the question. But it is interesting how Powell seems to be willing to acknowledge the thing. Prior Fed chairs have said, this is not something that is in my world. But just coming out and kind of acknowledging those risks, let's say.
Yeah, for sure. I think he is very careful when he does it. He says, the Fed is not in charge of the stock market. But, that being said, it is hard to ignore in this moment. And it's a bit odd, when you think about it. He's very concerned about labor, and yet, stocks are ripping here. So, I think it makes him seem kind of human that he's willing to acknowledge the weirdness in this market right now.
Claire Boston, appreciate it.
Thank you.
All right, here to stay on the reaction to Powell's remarks and a little bit of what we heard last week is Ryan Wang. He is a U.S. economist at HSBC. So Ryan, let's just start with your thoughts on Powell's speech today. Kind of seemed to hew the line from Wednesday, but in your team's reading of it, anything additive in those comments, whether the prepared remarks or the Q&A that we heard from Powell today?
Yeah, well, thanks a lot for having me. The remarks were, broadly speaking, very much consistent with the press conference last week. One thing that we did notice was Powell's assessment that the current policy rate may only be modestly restrictive. And maybe that could potentially show that Powell might be thinking the neutral rate is only a little bit lower than where we are right now. And of course, this has practical relevance because as more rate cuts are delivered, we're going to get closer to that level for each FOMC policymaker. And eventually, you'll have policymakers saying, look, we're already at neutral, so therefore, we don't need to cut any further.
So I guess without getting too far into the weeds here, I'm just looking at your note and looking at the dots that we got last week. Does it feel to you like Powell is one of those dots that maybe isn't looking for any more rate cuts this year, or is he likely in that two-cut camp that we saw that had the plurality of the way they were divided there?
Yeah, that's a very interesting point. So if you look at the specific dots for the end of this year, basically it was a 10-9 split, right? So that's very, very close, with 10 policymakers looking for at least the additional 50 basis points this year, which presumably means October and December, but then 9 policymakers looking for less. Powell has always been pretty careful, I think, to not necessarily specify where he is. You could say the odds are he's with the 10 simply because it's greater than the 9. But what I was just referring to is also very relevant, the kind of the longer term neutral rate assessment. And once again, we need to look at those as well, where there is a big spread. And those that have higher numbers for that far side of the dot plot basically are probably going to be the ones that are looking for less rate cuts.
Now, we knew that when Stephen Myron was nominated to take that spot on the Fed board, that he would be, I won't say a wild card, but it would be an injection of pace, let's say, into the Fed proceedings. We saw his comments yesterday. We saw where the dots looked like, or what the dots looked like on Wednesday. How have you thought about this injection of a strong voice at this point in the cycle with a number of milestones coming up where you have likely nomination for Fed chair, you have possibly another full-time role on the Fed board opening up, just a lot of moving parts again in what is, what tends to be a pretty staid group, pretty staid proceedings there at the Fed?
Yeah, well, it's very interesting. And as you said, yesterday we had a speech from Governor Myron who explained his rationale. And really, I'm going to stay on this more technical, somewhat more obscure point I've been making, really making a lot of arguments, Governor Myron did, that the neutral rate may be far lower than where we are right now. And therefore, that justifies, of course, calling for that 150 basis points of cumulative rate cuts this year. So I think when you look at it simplistically, it's pretty clear where the divide is. Those that favor faster rate cuts are more concerned about the employment side of the mandate. Those that favor fewer and slower rate cuts are more concerned about inflation. But in the weeds, there's this sort of confusion and a range of views about what rate actually restrains the economy. Are we close to that rate? Are we modestly restrictive, like Powell said? Or could it be that actually the neutral rate is far lower, and that would imply that the current policy rate is actually putting a lot of downward pressure on the economy?
All right, so we've talked about it twice. Let's just, again, I'm looking at the note here. Let's just talk about it. We've got the long-term neutral rate from the committee. The median expectation is that that's at about 3%. Right now, we have the Fed funds rate in that range of 4 to 4.25. I'm just curious, maybe if you can sketch out then for us what that longer-term neutral rate, what those expectations were only a couple of years ago, because that's really been another shift through the Powell years, is that you've seen that neutral rate come up, the kind of guesstimate of the neutral rate come up, and that feels like part of the conversation that, I don't know, day to day is not really addressed when we're saying, well, is the Fed going to go 25? Are they going to go 50? The distance to their goal, that endpoint, has also changed quite a bit over time as well.
Yeah, that's absolutely right. So I would say that in the years leading up to the pandemic, maybe for at least a decade, the number that we typically had in our mind that you could see for this same neutral rate might have been in the 2.5% range. And now, if you look at the current FOMC dot plot, pretty much all the numbers are above 2.5%. You're ranging from just above that level to all the way close to 4%. And so I think there's widespread agreement that today's neutral rate may be higher than it was before. The disagreement is about how much higher it might be. And again, this is kind of the rate where you're balancing the kind of the interest rate that, again, is not going to put either upward or downward pressure on the economy. And if you're trying to control inflation, that might argue for putting some downward pressure on momentum. But if you're worried about the labor market, it argues for the opposite. Hence, you have this disagreement. Hence, you have a lot of focus on what the drivers of this employment slowdown are. All FOMC policymakers, I think, do see that there is at least some impact from slower immigration. But there, I think is some divergence about whether that's the dominant impact on these slower job numbers or whether it's still sort of just a minority impact, which means that actually businesses are becoming quite a bit more cautious and that we will potentially see some further increases in unemployment later this year.
Yeah, so let's finish on this then, because Powell introduced this idea of his view being much more attuned towards the labor market, his gaze being more on the labor market over inflation back at Jackson Hole. When you and your team look at the labor market right now, what do you see? What signals are concerning? What are there any suggestions that maybe that soft patch in the summer was just that? How do you see that set up? And are you kind of anticipating we could see 30, 40, 50 basis point increase in the unemployment rate over the next 6, 9, 12 months?
Yeah, well, I think over that time period, I think we will see that gradual increase in the unemployment rate. And what Powell, the phrase he's used a few times now is that we have a less dynamic labor market. And in a way, this is a means to explain that basically hiring is slower, right? And I still think that we have to say that both labor supply and labor demand are playing a role. And so it becomes a little bit trickier to say how worried we should be about this reduction in dynamism. But yes, I do think that at least a portion of it reflects business caution. That probably does mean the unemployment rate will drift at least a little bit higher by between now and into next year. But at the same time, this question about uncertainty, how much of this slowdown was related to tariff uncertainty and other sources of uncertainty. And some have even suggested we could see a reacceleration in the job increases going forward. So when you really boil it down, there's a lot of disagreeing views, even outright conflicting views on where the labor market is headed.
All right, we'll leave it there. Ryan Wang, U.S. economist with HSBC. Thanks so much for the time.
Thank you.
All right, coming up, Apple shares back in the green for 2025 after the release of its iPhone 17 lineup. We'll discuss the next catalyst for the stock. And gold keeps hitting record highs. We dive into the why behind the high. Plus, a banking playbook. One expert discusses how to play the financial sector in a lower rate environment. Stay tuned. All right, Apple shares are racing losses for 2025 last week. The tech giant turning green for the year in the days following the release of its newest products, including the new iPhone 17. For a closer look at the Apple story right now, let's get to Needham senior media and internet analyst Laura Martin. Laura, let's just start with your reaction to what we saw from Apple a couple weeks ago now, their new product lineup. And I think we agree on kind of how I felt coming out of that presentation.
Yeah, very lukewarm, no innovation. I think they're under pricing pressure, which is why you saw them raise no price except for the Pro. One of their models went up by $100 because they introduced a new tier. But really, they're under pricing pressure, and they've elongated because there's no reason to buy a new iPhone. The only reason people are buying a new iPhone is because their iPhone is now 7 years old. Or 6 years old, and they just need to get a new iPhone or leave the ecosystem. So all of that is elongating replacement values and lowering the potential earnings of Apple.
And I'm curious, how you've thought about the lack of an AI story, let's say, around Apple, and how much that to you matters around the story, or is this kind of like elongated, less exciting hardware replacement story just going to be very difficult to overcome, no matter what your AI strategy ends up being?
Right. So, I think the problem is that their biggest competitor is Android, which is owned by Google, which, as you know, is integrating its LLM called Gemini into every product it has, including, of course, Android. So while Apple has an outstanding defensive moat around its installed base, the fact that they can't raise price anymore, that people aren't replacing their iPhones. It used to be every 4 years. Now it's like 6 and 7 years. All of that makes it scarier because if Android rushes ahead, there will be a breaking point at which a year from now, 3 years from now, people will start leaving the iPhone ecosystem because Apple is falling further and further behind from their primary competitor, which is Android.
Now, you're hold rated on the stock. I'm curious, when you're meeting with clients, with investors, is this a stock that, one, either people buy and they're just kind of wishing it to go higher, or two, is it a name that people want to overweight but they just can't get there? What's the reaction, the sentiment, I guess, in those conversations around the Apple story today?
Right. So I would say the two primary holding groups of Apple today are A, defensive, meaning some people think that generative AI is really overhyped. And if you think generative AI and the returns on capital for all the investment other companies are doing on generative AI, then Apple is exactly the right place to hide because they're spending $12 billion this year on CapEx, while Amazon and Google and Meta are spending $85 billion to $100 billion this year on generative AI with absolutely no incremental revenue that's identifiable linked to that spending. So if you don't believe in generative AI and the future of retooling the American economy, then Apple is a big reason to own that because they have free cash flow. They're shrinking their share base with their free cash flow. They're delevering. So I would say that's one group of Apple holders. And then Apple is heavily retail owned. And I think the other reason is the ecosystem, that people cannot imagine trading in their iPhone ecosystem for an Android. And that then they take that anecdotal feeling about they have and they just stay in Apple because it really does have a very powerful ecosystem.
All right, let's switch gears to another company you cover, which has been in the news in the last couple of days, and that is Disney. You were out with a very compelling case late last week around Disney's ABC asset, and that rather than sell it, they should just shut it down. I'm curious if you could just walk through some of those mechanics and some of your thinking around, around that property.
Yeah, sure. So we basically published this note today saying that they should just shut down the TV broadcast company called ABC, not sell it, just shut it down. And our logic was that because of the comments of FCC Chairman Brandon Carr last week, Disney lost 3% of its value in its shares. So then we valued ABC, and the answer is all of ABC, if they just shut it down, is only worth 5% of its value. So if you shut it down and created a discontinued operation, I think Wall Street would add it back. And if you shut it down, what would happen next is that Disney's revenue growth rate would accelerate because ABC is structurally shrinking every year, so it's lowering Disney's reported growth rate. And therefore, at a faster revenue growth rate, Disney would also command a higher valuation multiple. So when we do the math, we felt that Disney would actually add about 10% to its total shareholder value if it just shut down and took a write-off for the ABC network. And so our point was, and if they get out of ABC, nothing else they own is regulated. So now you don't worry at all about federal commentary or intervention in your business. They have a film business, they have theme parks, they have streaming. None of those assets are regulated, which is increasingly important in a generative AI disruptive world. If you think like I do that generative AI is potentially a really disruptive force, management teams really need the ability to act quickly and react quickly to technological innovation and improvements. And anything that has a regulatory aspect, especially if it's the tail wagging the dog, like at the Walt Disney Company, slows your ability to react. And therefore, we think that becomes more costly over time. So our attitude is get out of ABC, take the one-time write-off of 5% of your value, and after that, just grow faster.
And then on that, what would be the RemainCo, let's say, although it's the majority of the company? Disney Plus would be, in their streaming efforts, a major part of that. Headlines just earlier today, the company planning to raise prices for that again next month. Let's just take Disney as it is today. Do you expect the company to be this aggressive, let's say, going for a price hike roughly every year on Disney Plus to kind of try to find a breaking point for consumers? Or how do you see Disney thinking about that suite of streaming products? ESPN launched last week, and how aggressive do you expect them to be in the years ahead around pricing for these products, particularly the Disney Plus asset?
Right. So, I expect this to continue for all these streaming companies. As they lose the dual revenue stream from the linear TV network, they must replace those economics with streaming. And it's very clever to have a bigger and bigger difference between the ad-driven tier and the tier without ads. And we've seen at Netflix, which is like the industry leader, I think they have a $21 price point if you don't have ads and a $7 price point if you do have ads. I think that's going to become the norm, and it gives Disney plenty of room to increase their prices. I also think that cleverly, Disney is driving people to the bundle because they will heavily discount the bundle of the new ESPN flagship product plus Hulu plus Disney Plus, and you're going to get a big discount if you take all three of their services, which is sort of like what McDonald's does. They supersize you by sort of giving you the third product for free or for 50% off, compared to if you bought the products a la carte. All pricing strategy is exactly what drives bundling faster. So I expect Disney to continue to use price to try to drive people to the supersized bundle of all three services that it offers.
Yeah, we started this conversation with anecdotes around the Apple ecosystem. I don't even know what I pay for any of these services, so I guess that means the companies still have pricing power, at least so far. I'll let you know when I see my credit card statement and decide I've seen enough, and then we'll revisit the stock. All right, Laura Martin with Needham, thanks so much.
Thanks so much.
All right, now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joins me here at the desk for a look at these names. Brooke, let's start with what we saw from CoreWeave, that stock getting an upgrade at two different firms earlier today.
Yeah, right. Wells Fargo and Myles Research both upgrading CoreWeave today. But despite that, we are seeing a pullback in shares just a bit, down about 2.5%. And that's largely based upon this run up that this company has had year to date. It's up about 38% solely this month. And so really take a look at this momentum that it's had. We are seeing a bit of a pullback there. But Myles Research saying that they upgraded to buy from hold. They also raised their price target to about 165. They said the company is one of the beneficiaries of quote unquote accelerating cloud demand, both right now and in the future. Then Wells Fargo, we also got an upgrade there to overweight from neutral. The analysts there are also raising their price target to 170 and really saying that demand signals are growing, too strong to ignore, while the rest of the software is stuck waiting for AI monetization to really surface. CoreWeave stands to benefit. Right now, the stock is around 130, and so certainly room to run about $35, $40 to those price targets that we have today.
Yeah, certainly feels like one of the IPOs that will define 2025 in markets. All right, let's turn our attention now to our top trending stock on Yahoo Finance. That's BigBear.ai. Stock is up about 15%. The company announcing it will showcase AI-powered capabilities in collaboration with SMX at Unitas, the U.S. Navy's annual multinational maritime exercise.
Yes, that's right. That's exactly what's going on.
I'm a Navy family, so I know about these things.
Oh, so I love that. So basically, they're really just goes to show that AI, well, surprise, but all our trending tickers today have to do with AI. But Big Bear really leaning into that opportunity there with the naval force here. They are also worth noting that this company has seen quite the run. It's trading near highs that it saw back in February, and so it's been quite the year as it's sort of tried to get in on this AI play. They're saying in their release that there shows this commitment to deliver AI-enabled mission solutions to enhance, once again, operational readiness. But when I went to go dive deeper into the coverage and the analyst coverage that we have on the street, it was quite minimal. They only have 2 buys and 3 holds, 0 sells on the street right now. So very minimal coverage. Of course, the stock is only about $8, which is trending well below what we're seeing other AI stocks.
Yeah, I feel like it's one of these tickers that is just constantly trending with our audience.
Yeah,
and
it's top, number 1 today. I was surprised to see that too.
I feel like part of it's the name.
Big Bear.
It's a great name. It's like, I got to know what's going on with Big Bear. And to your point, it's $8 a share.
Yeah, $8 a share.
Even though that's not the valuation, but it's like, sure, I can get 2 shares instead of whatever, right?
And it's up it was up as much as 16% today. And so when you see a stock move that much, there definitely is this intrigue on what exactly is happening here, what's the story here, and it seems like this partnership could be big.
Well,
to look out for.
My read on it was potential read-through is they could be signing a bigger government contract, right? If you're showing off your capabilities at this exercise, then maybe that's coming down the pike. Stock has nearly doubled since September 10th looks like the most recent low. All right, let's move on here. Last trending ticker, Vistra, hit with a downgrade over at Jefferies, the firm lowering its rating on the stock to hold from buy.
Yeah, so we got AI infrastructure, we got partnerships with Naval Base, and now this one around the AI demand when it comes to nuclear power plant and the potential, once again, of that as well. Jefferies downgrading to hold from buy here based upon this delayed data center development. The analysts there are saying that the odds are dwindling of this happening near term. We did hear from the CEO on their recent second quarter earnings call that he had felt very good about where things stand in getting a deal done for their nuclear plant, but now there seems to be some hubbub about when exactly this could happen. Will it happen? Who will the partner be? And largely what we've seen year to date is this stock up about 50%. And so now with no deal announced, definitely we are seeing that pullback in shares.
Look what happens. You sit next to Jake for 3 months, all of a sudden it's just nuclear this,
power
that.
Check out his data centers, nuclear power plants, or Jake Conley on our site. He has it all.
Guy walks in every day, tells me about all these power things I need to know about. I'm never sure what to make of it. All right, look to Palma. Thanks so much. All right, coming up, a deeper dive into Nvidia's latest AI investment, more market domination on the other side of this break. All right, Nvidia is investing $100 billion into OpenAI. Yahoo Finance senior reporter Ali Canal sat down with the CEO of Frontier Foundry to talk about the implications of that partnership.
It's definitely one of the most interesting capital investments we've seen in a while, and hopefully will help scale this up in a way where the overall price to delivery goes down. OpenAI's infrastructure set is starting to get a little old compared to other players in the space. So this is a big investment, a big vote of confidence from Nvidia, which obviously makes up the vast majority of OpenAI's infrastructure, and hopefully gives OpenAI the opportunity to continue to find that revenue that they're missing right now.
And Solon, it's interesting because not everyone has been swept up in the optimism. We heard from one analyst, D.A. Davidson Galoria, who said that Nvidia is acting as the, quote, investor of last resort, bailing out OpenAI's extended commitment. So do you view that as a red flag at all?
Well, there are kind of 2 different red flags, or I'd say at least yellow flags that are in my mind right now. The first is that we're exiting kind of version 1 of this generative AI market, and we haven't seen someone hit that Google moment or that iPhone moment where the revenue just geometrically goes up. The second is we're seeing a big separation between enterprise and government utilization of these technologies and consumer utilization of these technologies, and so as the market matures, you can continue to see this kind of fragmentation happen, and newer companies that are more focused, more narrowly defined relative to enterprise value are doing far more with far less money.
And far less money. According to Bain, there's a new report that AI companies may fall $800 billion short in revenue by 2030, given current monetization rates. So is Nvidia the only one that's making money in this space right now? I mean, when can we expect the others to catch up?
It's a great question, and frankly, right now with this version of the GPU technologies that Nvidia is getting everyone to use, which is in their own best interest, right? Buy my chip and then rent it out to everyone else. It's a great way to alter the spreadsheets and make sure that you're still making money. Everybody on the other end is going to be racing to the bottom in terms of commoditization and trying to get those prices down as much as possible. So, 2 years from now, I would expect to see this market radically altered. And I think a lot of the big data center projects are never actually going to get fully, built up to fruition, because this technology is evolving incredibly rapidly, and needing a GPU to run a transformer, which is really what this is about, is no longer required. You can use CPUs, you can use alternative chipsets, and all of that other innovation is coming very rapidly.
And what are the implications of that, Sultan, if we do see that extremely altered landscape from where we are right now?
Yeah, I mean, for the last couple of years, we've seen a massive concentration in venture capital and capital investment in a very small number of companies, while there are thousands of other companies out there that are doing incredibly interesting, high quality work in artificial intelligence on smaller scale infrastructures, whether it's a laptop in some cases, or an iPad, or a single server sitting in a desk, these edge compute use cases. We're going to end up seeing this bifurcation of the market from one version where it's all big GPU farms for very specific large scale use cases, but the enterprise value is probably not going to come from that. It's going to come from people who are using smaller scale infrastructures to drive process optimization, to drive lower costs, to drive better bottom lines, to get to market faster. And I think at the end of the day, the question I wonder is OpenAI, the next Google, or is it the next Ask Jeeves?
So as an investor, what should you be looking at? Should you be looking at some of those smaller players and maybe not focusing so much attention on the big shiny objects like your Nvidia?
Yeah, I have always focused on what's the ROI. Are you going to end up being able to invest in something that will drive a return on investment that justifies the amount of money you're putting in? Right now, there are a lot of companies out there where the ROI is far more straightforward, and there's a far more linear path from I put $1 in now, I get $7 out in a few years. And so, a lot of these bigger, kind of pre-COVID or through COVID AI companies just are very expensive. And frankly, it's not clear that you'll be able to get your money back. Nvidia is always going to be a different case because there's just so much demand right now. But 2 or 3 years from now, I'm not sure that's necessarily going to be the same.
And finally, I want to end on what I've been ruminating on, which is this flywheel of investments. Nvidia, Intel, Nvidia, OpenAI. You have OpenAI, Oracle. What do you make of what's going on in this space right now when it comes to sort of the pockets of money changing within this same circle?
Well, when 70 to 80% of the investment capital expenditure that people are talking about is locked into less than 20 companies, it's really hard to see anything outside of that, right? That little bubble, and you just did a great job explaining it, is this nice little bubble, and all they're doing is trying to keep it moving until they can get enough enterprise revenue to justify the amount of money they've put in yet, and that's not happening at the pace that everyone wants. That little bubble you just talked about is not an area that I find, frankly, that interesting from an investment perspective. And so much of the very interesting technology that's being developed right now is outside of that bubble as well. So if you're really thinking about 2, 3, 4 years from now, that bubble is going to be there, but it's sort of like saying, AWS is going to be there, or Azure is going to be there. Well, of course they are, but is that necessarily going to be your high growth market, your high innovation market? I think there's some question there.
All right, coming up, we'll have your financial playbook. We'll discuss stock picks for your portfolio in a lower rate environment. Stay tuned. All right, gold rising again on Tuesday to a record high. Senior markets reporter Ines Ferré has more. Ines, I feel like we sat here yesterday and had the same conversation.
We did, Myles. Gold, another record high today. Today, though, gold futures surpassing 3,800 for the first time. Spot gold below 3,800, but still, nonetheless, yet another high for gold. One analyst actually noting that each push higher squeezes out the short short positions. So that may be part of what you're also seeing. But there's also been another catalyst, and that is also China considering turning into a custodian for foreign gold reserves through its Shanghai Gold Exchange, enticing allied countries to purchase gold and to hold it within its borders. So that's also bullish for gold. But make no mistake, look, 42% year-to-date gains for gold. Of course, a lot of this has to do with central banks that have been buying up gold. You've got the Fed easing. You've got this dollar that's been declining. And Wall Street, though, still sees further gains for gold going into 2026. UBS coming out with a note today saying that they expect gold to go to 3,900 by mid-2026 if the Fed keeps easing. And if we keep seeing elevated inflation, this is a bullish scenario for the precious metal, Myles.
All right, Ines Ferré with the latest on one of this year's hottest trades. All right, well, the Fed last week cutting interest rates for the first time this year, and we're navigating how to play the banking sector in this new rate environment with the Yahoo Finance playbook. Joining me now is Chris Whalen. He's the chairman of Whalen Global Advisors. Chris, let's start kind of top down. We have rates. We've seen the rates come in, certainly on the longer end of the curve. We now know we're entering this rate cutting cycle. As you look at financials, your coverage universe, how has this changed, the setup, and what do you see the early implications of at least that move, for the companies that you're following?
The big issue for banks in the last 4 quarters has been a lack of loan demand. Deposits are growing 4.5%. Loans are growing about 2%. So the difference is going in the securities, obviously, and huge share repurchases this year. The Fed gave them all a thumbs up in the stress test. They're going to have record share repurchases. So the question is, if we have rates fall, do we see volumes pick up? That's really, I think, the key question. To me, the most attractive members of the group are the ones with exposure to the mortgage market. So think about Western Alliance, who owns one of the biggest conventional issuers. JP plays in that market, but many of the ideal names, I think, are not even banks. They're mostly non-banks, Penny Mac, that sort of thing.
Two things in there I want to click on. The first is that capital return story, and really kind of, I think, getting rid of we've had it at various points, but it feels like the financial crisis is really over now, at least to me, and kind of how that plays into the way that you're looking at banks, where it can be a material, that can really grow. It's not just, we hope the Fed will allow us to. That can be a real part of the story for these companies.
Oh, definitely. And because the Trump administration is changing a lot of the Basel capital requirements, you see banks buying back their preferreds. They're going to retire them entirely. So we're taking income out of the market. For investors who want to, they got to go look somewhere else. I think the banks are interesting simply because they have a lot of competition now. There's been a whole parade of new platforms going after the consumer. And the business side is fairly slack, except for non-bank financial companies, which have been growing double digits. So the rest of the portfolio is barely growing. But hedge funds, all the rest of them, the credit trade has been attracting a lot of attention from the banks.
Now, you mentioned Western Alliance and the regionals, and we've had a lot of conversations here around the potential for bank M&A, more bank M&A, even larger firms getting involved. How have you thought through the potential there, things you've mapped out, just how big these firms may end up going with the ability to finally do deals after 10, 15 years?
Well, we have been seeing deals. Nonetheless, the key thing is, does the target make sense? So, in most cases, the deals we've seen over the last year or two, they've really overpaid. To me, I'm much more of a fundamentalist. If I see somebody paying 2 or 3 times book for a bank, then I know they're not going to get their money back. It's just basic arithmetic. But I think, yes, if bank stocks retreat, and I think they will, I think we're looking at a peak right now, because April they bottomed out. That's when I told my guys to get in. And by August, it was time to get out again. So now the question is, do we stay in? I think not. I think the large caps are going to give ground. The story stocks, the SoFis, the lending clubs, they're still going to be, I think, viable. But I think you're going to look for the increase in credit costs perhaps in the third quarter and the fourth quarter, if we start to see that, then I think the street's going to retreat from the banks because we've had a benign year. Yeah. We've had credit costs falling since last year. Mm-hmm. Remember, we were talking about a recession. Yeah. No recession. So other than the commercials,
been a year away for the last couple of years.
No, exactly. But other than the commercial side of the ledger, commercial real estate, multifamily real estate, even the credit sector too has been mixed, and the banks are hiding a lot of it. Mm-hmm. They're using forbearance. They don't want the building. Yeah. They're going to keep the tenant in the building. Yeah. So that kind of behavior, also some changes in accounting presentation for restructured loans, makes the banks look better than they really are.
So let's talk about some of those story stocks, the newer entrants into the sector. And you were kind of looking through your notes, and it's interesting just to see, a SoFi is now on a screener chart next to a JP Morgan. And
my God!
Can you maybe just break down for us what the economics of one customer looks like at some of those different firms, and how different that is with those names now playing in the same universe for a lot of investors?
Well, SoFi is seen by a lot of people as a student loan shop. Yeah. They were helping people get out of their student loans and also manage their money. But the assets per customer and the revenue per customer at a SoFi are much lower than what you see at a JP Morgan. And that to me is key because over time, the bank still has to compete with the other banks. Their overhead costs are astronomical. They have the highest overhead of any bank in peer group 1. So what that tells you is that they are still trying to grow into a Silicon Valley kind of a lifestyle for their management team. Mm-hmm. And I think, that's fine. It certainly caught the attention of equity managers this year. But over time, they do have to compete with everybody else. So again, Lending Club, as long as credit is benign, no problem. And they've done all these deals. They're selling, debt on their platform for BlackRock and all the rest of it. Great. But if credit costs go up, all of these guys are going to suffer because what do they do mostly is unsecured consumer lending. Mm-hmm. We haven't seen what these platforms look like through the cycle since 2008. Yeah. It's a long time, right? But we haven't had a real recession. So Ally, Synchrony, all of these big consumer lenders, even Capital One, we don't know what they'll look like next year if credit costs go up. And I think that's why Chairman Powell is so cautious on this whole issue with inflation, because on the one hand, they're worried about the economy, but then on the other hand, he's staring at inflation numbers.
Well, I'm curious also, you mentioned, kind of some of the CRE things where, how a bank might think about that. But that made me think of this whole universe of whether it's private equity, private credit, whatever you want to call it, trillions of dollars now. Firms acting like banks, basically, but not being banks at all, how that factors in as you look at both the valuation for banks, but also, as we're kind of talking around, risks in the market if the cycle turns, when the cycle turns next.
Well, this is why regulators are so concerned about banks lending to non-bank financial institutions. They know that non-bank financial institutions don't have the staying power. If a bank has a bad credit, they could just put it in a closet and let it sit for a while. Or if they take a property, they can just hang on to it because they have deposits to fund it. Non-banks don't. And you've seen the big Apollos and Ares and all the rest of them, Brookfield. Everybody's in this trade now. Yeah. But if the trade starts to see a diminution in liquidity, then we have a problem.
Yep. Talk about it for years. We'll see.
This will be a great story next year.
I was going to say, it feels like the one that I'm going to spend my whole career looking at and waiting for that.
Well, we haven't had a real crunch since the Great Crisis. 2021 was bad, but very temporary. So the question is, with credit still looks great. If you look at 2021, credit's been flat since then.
Yep. All right, we'll leave it there. Chris Whalen with Whalen Global Advisors. Thanks so much for the time.
Thank you.
All right, well, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the close of bell. Stay tuned for Market Domination Overtime.